In this video, I am analyzing pharmaceutical companies. All of these companies have my investments in them. Maybe with a different degree, we'll be analyzing stocks like Lupin, Natco Pharma, Glenmark Pharma, Ajanta Pharma, Sun Pharmaceutical Company, and Aurbindo Pharma. These are 6 companies, and we have around 60 ratios to look at. So this video will be a long one, more than an hour. Feel free to skip through whatever ratios you're okay with, and also as I keep looking at each ratio, I'll be explaining its meaning first, as I usually do in all my videos, and that will help new investors to understand what that ratio signifies. For example, if I say PE of 12 months is 53.97, it really wouldn't make any sense. That anyone can read as well. But when I say price earning of last 12 months and I explain what price earning is, and then I tell 53, then they understand what this 53 signifies. So here my purpose is dual. One is I get to update my knowledge. Second, if someone gets helped by my analysis, more than welcome. So let us begin with these ratios. Lupin's current market price is 723. Again, I won't be repeating the ratios for each of them. Some of them I may skip, and I'll be giving a ranking from 1 to 6 for each script depending on how good the numbers are. These ratios basically have a dual purpose. One is we can look at valuation, where the price is. Second is how the quality of the company is, management is, by looking at certain ratios like RoE, RoCE. Those are return on capital employed, return on equity, sales growth rate, profit growth rate. These are quality ratios that helps us understand how the management is running the business. Then we have financial ratios, leverage ratios. What is the debt? How much is the debt? How much is the profit against the debt, and so on. So there are many ratios that we'll go through, and each ratio has a particular significance as to what it wants to tell us. So the numbering system is like 1 is the lowest mark for the ratio, which is the worst case scenario, and 6 marking for the best performing script. Lupin's current market price is 723 rupee. Today's date is 19th June 2019, and most of these companies' data is up to date till March 2019. Some of the figures considers March 2018 data for analysis, but otherwise it is up to date till March 2019. Lupin's stock is down by 26% from where it was 52 weeks back, or basically we can also say where it was 325 days back, or a year back. So from a 1 year it has fallen 26%. Natco Pharma's stock has fallen 37% from 1 year back. Glenmark's is 26%, and so on. The highest fall was seen in Sun Pharma at 42% from its 52 weeks high. The least fallen script would get highest ranking. The one which has fallen the most will get the least marks. In terms of the percentage fall from its 52 weeks high, Ajanta Pharma has fallen the least at 25%, and Sun Pharma has fallen the most at 42.2%. Let us look at the earnings per share and the earnings yield of the last 12 months. This is the latest data on which the EPS and EPS yield is calculated. Lupin's earning per share is 13 rupee per share, that is on a price of 723 rupees. It has earned 13 rupees in the recent 12 months, and the yield, that is on 723 earning 13 rupees, works out to 1.85%. So that is the yield. Now just looking at the EPS as a standalone figure, investors or we wouldn't be able to understand whether that number is high or low. So just because a company is earning 13 rupees per share does not mean it's bad, or a company earning 40 rupees is a good company. We have to convert it to the yield or earnings yield by comparing the price and the earnings. So looking at the earnings yield, Lupin is at 1.85%, Natco Pharma 6.56%, and so on. Let me give the ranking and then come back. The highest earning yield would get the highest ranking and the lowest earning yield would get the lowest ranking. As far as the earnings yield is concerned, Lupin earning yield was the least at 1.85%, that is on a price of 723 rupees. It just earned 13 rupees in the recent 12 months, whereas Natco Pharma had the highest earnings yield of 6.56%, that is on a price of 532 rupees. It had earned 34 rupees on its per share basis. Next, let us look at the price earnings multiple of the recent 12 months, and then also we'll look at what was the price earning multiple of the last year, that is 2018, and we have to also look at the historically where the price earning was trading, as well as the last 3 years. All these ratios will go through at one go. These ratios are available on screener.in. Investors can go to the website, look at these ratios. It is not available in this particular format, but what I have done is I have copied and pasted it into Excel in a vertical format. So if interested, investors can go onto this site and look for these ratios or add it into the peer group comparison table for better analysis. So in the recent 12 months, the price was quoting 53 times higher than its earnings. The way to look at it is in this way. The price, which is 723 rupees, was quoting 53 times higher, that is then the earnings, that is 13.4. So 723 divided by 13, that is price divided by earnings, which it stands for, price earning, we get 53 times. Price was 53 times higher than its earnings. So this ratio helps us understand where the price is trading compared to its earnings. We don't want to pay a very high multiple as against the earnings of the company. Now let us also look at how the other peer group companies are trading in terms of price earning, what multiple they are asking from the investors. Natco is available at 15 times, Glenmark at 16 times its earnings, Ajanta at 21 times, Sun Pharma very expensive at 36 times, and Aurbindo at 15 times. Now as investors we should look for a price earning multiple of less than 25 times. So here we don't want to pay 25 times more than what the company's earnings. Some investors would want to even pay lesser or lower than 25 times because other ratios are not up to the mark that because of which it wouldn't justify even paying 25 times. In this case, the lower the price earning multiple, the better or the higher the rank, and the higher the price earning multiple, lower the rank. So as far as the recent price earning is concerned, Lupin is the most expensive. Its price is way too high than its recent earnings, that is 53 times. Whereas Natco is available at just 15 times its earnings. Many investors like to see it in exactly the opposite way, that is the higher the price earning multiple, the better it is. But as far as I understand, here the earnings has fallen to 13.4, or earnings is at 13.4 rupee per share, whereas the price is at 723. Now this is I know for sure that the latest year's profit has fallen for Lupin, and the price hasn't fallen substantially to cover that fall in the earnings. That is why the price earning is very high. This does not justify that investors are giving it a high valuation. I would definitely want as low a price to the earnings as far as possible. So here Natco is the most economically priced when compared to its earnings at just 15 times. Let us look at the 2018 price earning, where the price earning multiple was in 2018. Lupin even in 2018 was quoting at a very high price earning multiple of 130 times. That is, price was 130 times higher than its earnings of that year. The other peer group companies, Sun Pharma was trading at 43 times its earnings. Even in the last year's price earning multiple, Natco was available at the lowest valuation, and Lupin was the most expensive at 130 times its earnings. Now let us look at how it was trading, how these companies were trading historically since last 5 years, and on average how the price multiple was, or where the price multiple was in the last 3 years. Lupin's historical 5 years price earning was 45 times. Since last 5 years, its price was 45 times higher than its earnings. And in the last 3 years, it has gone even higher at 56 times. Again, as investors, we don't want to pay more than 25 times. For me, the benchmark is 25. That is, the price should not be more than 25 times its earnings. Many times in this videos, I'll be repeating the statement again and again because I want to stress on the importance of certain sentences that I'm saying, so that investors know what is important and which points they should keep in mind when they are looking or analyzing a particular company. Natco's price earning multiple was also very high since last 5 years and 3 years, about 25 times. In last 5 years, it was trading at 32 times its earnings, and 3 years at 37 times. And the recent 2 years, that is 18 as well as latest 12 months, the price earning is very attractive. Glenmark's price earnings were very high again, 37 times and 44 times, whereas the recent price earning multiple has become very attractive here as well. For Ajanta, price earning multiple again was about 25 times for both 5 and 3 years, and the recent price earning multiple, although is high, but the last year's was 18 times. So this is within the range but at a higher level. Sun Pharma is we need to look at the 5 years historical was very expensive, 39 times. Even since last 3 years, it has been quoting at 42 times its earnings, whereas the recent price earnings are still very expensive. It is still quoting at 36 times and 43 times of the 2018 earnings. Aurbindo, all price earning multiples are very reasonable. Historically, it has been trading within this range of 15 to 18 times. So what happens is, when we understand what is the latest price and what is the last year's price earning multiple, that we get a comparison, we get a understanding where the current price earning is, and also when we look at it and compare it with the historical price earning, we get a bigger picture, a better picture of where the price earning multiple was trading since many years. So historically also, if we look at both for 5 years and 3 years, Lupin was at the highest price earning multiple since last 5 years and last 3 years, whereas Aurbindo since last 5 years and 3 years was trading at the cheapest price earning multiple of just 17 times and 18 times. Let us look at the price with the OCF comparison, that is current market price compared to the operating cash flow. Here, this particular ratio helps us understand where the price is when compared to the cash earning. Now let me explain what is the difference between earnings and cash earnings. So the earnings is the net profit value per share, and this net profit is calculated by considering all the expenses, whether those expenses have been paid for or not paid for. That is, whether those are cash expenses or non-cash expenses, those are accounted for in this year, and then we get a final net profit value. Whereas in the OCF or the operating cash flow, only the cash expenses are considered in the calculation, and that too only through the operations of the business. So there are three types of activities in a business. One is operating activity, investing activity, and the financing activity. So when we look at the cash flow statement, we see these kind of three breakups. Out of that, here for this analysis we are just considering the first one, which is the operating cash, or cash coming in through the operations of the business. We are not considering the investment activity, we are not considering the financing activity, and we are also only considering the cash which has come in through business operations or cash gone into the business operations. So this particular value gives us a very good picture of how the company has actually done in performance in terms of cash. As we go down below, I'll explain again what this cash means. So Lupin's price is 18 times higher than its current operating cash flow. This operating cash flow is of course of 2018, because as of today the latest OCF value is not available. So as in when the latest 2019 data is available on Screener, I'll be coming out with another video of the same companies, and we will reanalyze them, how these ratios have changed over a period of time. So Lupin's cash wise, it is very economical at 18 times. We saw for earnings, price earnings multiple here, it was available at 53 times, whereas for cash it was available only by paying 18 times. So what, as investors, what we need to look at is not the price earnings of the latest 12 months, but what is the price to cash that the company has generated, or where the price is compared to the cash. So we want this also to be below 25 times. This justifies that the company is generating good amount of cash against what it is showing as profit. So here Lupin's price is 18 times higher than its cash, which came in through operating activities. Natco's price to OCF is at 20 times. Glenmark's is at 9 times, which means that the cash that the company is generating is high or very high compared to the other companies. Here the price to OCF value should be below 25 times. As low as possible, the better it is. So in terms of price to OCF, Glenmark has generated the highest cash, and its price to OCF is the lowest at only 9 times. So investors can pay just 9 times when looking at its cash generation capability. Whereas Ajanta Pharma was the most expensive in terms of cash at 29 times. Next, let us look at the current market price to the free cash flow. The free cash flow, like OCF, includes only cash component or cash coming in and going out of the business operations, as well as investment activity. So what has happened here is we have also added the cash coming in or going out of the business through the investment activity part as well as the operations. So this particular value further helps us understand how the company is done in terms of keeping a free cash with itself after doing the its business operations and after doing all its investment activities. So this cash that is free can be used for distribution purpose to as dividends or for acquisition and so on, for other financing needs and so on. So here too we want it to be below 25 times. So the price is currently available at 18 times for Lupin when compared to its free cash flow. Natco is at 169 times. So what this particular thing signifies, this high price to free cash flow, is that the company's free cash flow generation is very low. So in this case, as I mentioned earlier, the lower the better, and below 25 times is what we should be looking at. So as far as ranking is concerned, the highest price to free cash flow ranking wise is Lupin at 18 times, the cheapest one available, and the most expensive is Natco Pharma, where the price was 169 times higher than its free cash flow generation. Next, look at the price and compare that with the book value of the company. Now all these, price to OCF, price to FCF, and price to earnings, as well as price to books, then price to sales, these are valuation metrics or valuation ratios which helps us understand where the price is when we compare it with these kind of variables. So let us look at the book value. Let me quickly explain what the book value is. Book value is basically net worth of the company. The net worth is the actual value of each share as per the company's records after the company pays off all its liabilities and by selling all its assets. So whatever remains goes to the shareholders for distribution. So that is the actual value of the shares. Now here we don't want to pay more than 2.5 times the company's book or actual shares value. We want to pay as less as possible when compared to the actual value of the share. Lupin's shares were available at 2.38 times its book value or net worth of each share. Most of the companies are trading above this level of 2.5 times. Price to book value, the most expensive is Ajanta Pharma at the highest price to book value multiple of 3.7 times, whereas Sun Pharma was the cheapest one, available at just 2.27 times. Next, let us look at the price and compare it with the sales. In other words, what was the total market cap or how much the investors valued the company in the market against the sales it did in the last year. So this particular ratio helps us understand how the company is doing in terms of sales, where its sales are compared to its market value. Lupin's price in the market or the total company's market capitalization was 1.96 times higher than the sales. So there was not much of a difference. Whatever the company's market value was, half of that, that is 1.96% less than that, were sales. Or in other words, the total market value of the company was 1.96 times higher than its sales. Now these numbers are for a person who is not very interested in understanding will find it very boring. But for a person who is really interested and wants to understand how the company is doing, these numbers tell a picture of what the company is doing and whether we should invest, and would it be wise to not go for a particular company and then go for someone else who is doing much better. So let us look at the sales. Now this particular ratio also helps us understand what is the quality of the management, how much is the sales when compared to its market price. Natco Pharma's price was way too high than its sales, meaning the sales was less, but in the market the investors have given a very high premium to the company, and the sales are not matching up to it. So what we as investors, we want to look at the market price and the total sales of the companies should be as near as possible. The lower the ratio, the better it is. The more the price moves away from the sales, the more expensive it becomes. Price to sales wise, Glenmark sales are as near as its market capitalization, and Natco Pharma's price was way too higher than its sales. The sales were not able to keep pace with what the company's market price was or market capitalization was. So this was the most expensive of the lot. Next, we are going to look at the profit growth rate of the company in the last 5 years, how the company has grown from past 5 years and from past 3 years. What was the rate of growth in profit? These are CAGR growth rates, compounded average growth rates, and they help us understand whether from 5 years back how the company performed, and from 3 years back how the company has performed in growing its profit. It is also an indication of the management capabilities, how well they are managing their business, and is there a demand for the company's product, do they have the pricing power, and so on. So each ratio helps us understand a certain aspect of the company. Lupin, from where it was 5 years back in terms of profit, the profit has been falling at the rate of 26.6%, which is not a good sign. Here, as investors, we want to see a growth rate of at least 10% compounded over the last 5 years, and even in the last 3 years there should be a growth rate of 10% at least. Different companies have a different growth rates, so it is not strictly comparable, but when we look in the sector comparison, the growth rates have to be very similar, or although most of the companies wouldn't have the same growth rate, but it should be at a particular benchmark. Natco Pharma's profit has been growing at the 54% from past 5 years, and at the rate of 67% from past 3 years. These are very high growth rate figures. Glenmark's profit in the last 3 years have increased at the rate of 45%. When we look at the Sun Pharma, both the 5 years profit and the 3 years profit, it has fallen at the rate of 3% and 14%. So as investors, we want to always see a positive figure, and that too, if possible, about 10%. So in terms of profit growth seen in the last 5 years and profit growth seen in the last 3 years, Natco Pharma has managed to grow at the highest speed at 54% and 67%, whereas Lupin has performed the worst and profit has fallen at the rate of 26% in the last 5 years, and from 3 years past the profit has fallen at a higher speed of 51%. In fact, Sun Pharma also has not done well in terms of growing its profit. Next, let us look at the PEG ratio, price earnings to profit growth rate comparison. This ratio basically combines the price earnings of the recent 12 months, that is, what is the price we paid for the earnings, that is 53 times, but also understand what or how the earnings are growing every year. So here we are looking at the past growth rate of in fact there's no growth, in fact the profits are falling at the rate of 26%. So the price earning that the investors paid 53 times is not justified at all, even at the current price. And not only should it be below 25 times, in fact it should be below 15 times or 20 times, because there's no growth in profit from last 5 years. So the PEG compares the price earning and then divides that by the profit growth rate of 5 years. So we get an understanding of where the PEG is. Now the PEG should be between 0, that is above 0, and below 1.5. This is a fair value that gives us an understanding whether the price earning multiple we are paying is justified or not. So in this case we have a negative PEG, which means there was a degrowth in profit of 26%. So to put it in perspective, if we are paying 53 times the earnings and there is no growth in earnings, then it will take us 53 years just to recover our money. Now consider this, that instead of no growth, the profits are falling. So now think of how many more years would it take to just recover the initial capital. So as investors, we would never want to see a negative PEG, which basically denotes a negative growth in profit or profits falling from 5 years and from 3 years past. We want to see a positive value between 0 and below 1.5, which Natco Pharma through its ratios indicates. Natco's PEG is at 0.28 for the last 5 years and 0.22 in the last 3 years. This is again, if you look at the price earning that we paid for Natco was 15 times the best in the group. We were paying only 15 times more than its earnings, and we also had a very good growth rate in the earnings of 54% since last 5 years and 67% in last 3 years. Now what we do is we project this into the future, this growth rates of the past, and project this into the future to understand how fast we can recover our initial capital. So the lower it is to 0, the better it is. Let us look at the other PEGs. Glenmark's PEG is 2.99 for 5 years and 0.36 for the last 3 years. This is better. Ajanta's PEGs are also better at the borderline of 1.5 for the last 3 years. Sun Pharma's PEGs are negative, of course, because there is a fall in profit for both 5 years and 3 years. And Aurobindo's is in the benchmark of 0.2 and less than 1. So these are good values. So in terms of PEG for both 5 years and 3 years, Natco Pharma has done the best at 0.28 and 0.22, which signifies that the company has a high growth rate in profit, as well as the price earning multiple we are paying is the least. Whereas Lupin's PEG has become negative, which signifies that there is a fall in profit, but also the price earning multiple is very high. Next, let us move on to the sales growth. Just like profit growth rate, sales growth rate helps us understand how the company's or how the demand for the company's sales is, or how well the management has managed to increase its sales over a period of 5 years, or in fact even a period of last 3 years. Sales is an important aspect of any company's overall existence, because this is from where the entire flow of profit starts. If the demand for the company's product is not there, then you will see a fall in the percentage of sales. Lupin's sales has been increasing at the rate of 10% since 5 years past. That is, from 5 years back, how the sales has been growing. So it signifies that it is growing at the rate of 10% every year. And in the last 3 years, the growth rate has fallen to 7.35%. Here, as investors, we would want to see a 10% growth rate in sales. Of course, depending on the industry or the sector that particular company is, we'll see a different growth rates in profit as well as in sales. So that we have to understand where that particular company lies. No particular value is justified for all companies. Natco Pharma's sales are growing at a healthy rate of 27% and 38% in the last 3 years. Glenmark has also done well. Ajanta has also done well, about 10%. Sun Pharma's recent 3 years sales has fallen by the rate of 1.1%. That is, from 3 years back, the sales is dropping at the rate of 1.1%. Aurobindo has also done well to keep its sales growth above 10%. Here we want to look at the higher value as far as possible, and if it's negative then we'll give it the least ranking. Lupin's sales growth in last 5 years was the poorest. It was growing its sales at the rate of 10.38%, whereas Natco Pharma's sales was growing at the rate of 27% from 5 years past. In 3 years comparison, we see that Sun Pharma's sales has performed the poorest. In fact, the sales has been falling at the rate of 1.1%. This is very low, but still it's negative. And the Natco Pharma's sales also has increased at a healthy rate of 38% from 3 years back. Next, we'll move on to the return ratios. There are 6 return ratios: ROE, RoCE and RoA. Return on equity, return on capital employed, return on assets. And we also have return on invested capital along with asset turnover. So we will basically look at all of these at one go. Return on equity basically measures what was the shareholders' contribution to the company and how much profit it earned on shareholders' money. Whereas return on capital employed measures what was the total capital invested into the business by the shareholders as well as through borrowings, and how well the company has managed to generate profit on that particular capital. So this is the core difference between the two. Return on assets basically measures what assets the company had. Total assets includes each and everything that the company owns, including debtors, investments, cash, everything that is in the company, and on that how much the company has managed to generate as profit. So let us look at the return on equity of the last 5 years. On average, Lupin is earning 18 rupees on shareholders' money. Natco Pharma has been earning 24% as its average ROE. The highest was earned by Ajanta Pharma at the rate of 35%. Last year's ROE, that is 2018, was just 2% because the company had a fall in its profit. So therefore the return ratio also falls for 1 year. Therefore we want to see a bigger picture of last 5 years, because 1 year can distort the ratios. Natco Pharma's recent ROE was 29%, and so on for all of the rest of the companies. Now what we can also do is look at the average of these companies and then look at what it earned in the recent year on the equity shareholders' money. And we can also value it in that sense that Lupin's average was 18, but recent ROE has fallen below the average, whereas Natco Pharma's recent return on equity has gone above its 5 years average of 24%. So in this sense we also understand how much the ROE is improved when compared to its average of 5 years. Glenmark's ROE has fallen below its average. Ajanta's has also fallen. Sun Pharma's has fallen. Aurobindo's ROE is also fallen below the average. So only Natco Pharma has managed to increase its recent return on equity above its average ROE of the last 5 years. Next we will see how the ROE in the last 5 years has grown. That is, from 5 years back, how the return on equity has grown. Lupin's ROE has fallen at the rate of 40%. So from at 5 years back, whatever ROE it had earned, today it has fallen at the rate of 40%. Natco Pharma has managed to increase its ROE at the rate of 13%. And most of the other 3 companies have also had a fall in their ROE growth rates. Aurobindo has managed again to grow its RoE at the rate of 13%. So only Natco and Aurobindo have managed to grow its RoE from where it was 5 years back. Next, let us look at the capital employed and what was the profit generated on it in the last 5 years on average. Lupin managed to generate 22% on the total capital which was employed into the business. Most of the other companies have also managed well to generate high returns. Glenmark has performed the least at 17.19%. The recent RoCE for the most companies were above 10%. Here we want to see a RoE and RoCE value of above 15% for all the companies. Anything below 15% means that the company is not efficiently managing the capital that has been provided to it. We can also compare the RoCE of the last 5 years and with the latest RoCE. So we find that Lupin's recent capital employed was just 10% and it has fallen below the average. Natco has managed to bring its recent return on capital employed above its average of the last 5 years. Most of the company's RoCE, like RoE, has fallen below its average. In fact, Aurobindo has also not managed to bring its recent RoCE above its average. Let us look at the return on assets of the last 5 years. The company Lupin has generated 16.5% on whatever assets it had. Now this assets, to correct myself, is not the total assets but fixed assets that the company owns. So it has generated 16% on whatever assets it had. Glenmark managed to generate just 9%, which was above the double digit value which most of the companies managed to generate. So the higher the better. There are no benchmark values for return on assets. Now let us look at the asset turnover. This ratio helps us understand how well the company has turned around its assets to generate sales, or what was the sales compared to, or how many times the sales was compared to the assets that the company owned. Now this particular ratio measures the total balance sheet size to its sales. Here too we want it to be as near as 1 or below 1. Let me correct myself. We want the ratio to be more than 1 times. So which signifies that the sales were higher or multiple of the assets. We want 5 times the sales of whatever assets the company held, or 4 times the assets, or 3 times the assets. That is, the sales has to be multiple of the assets that the company owns. The higher the sales, the better it is able to translate that into the profit. So most of these companies, if you notice, are very near to 1 times its assets. Finally, let us look at the ROIC, or return on invested capital. This ratio measures what was the company's investments in the balance sheet last year and the profit that the company earned in the last year. This ratio in itself does not signify anything other than that whatever the company's investments were, on that what was the profit the company was generating. The highest ROIC for invested capital was Ajanta Pharma, earning 38% on its invested capital, whereas the least was Lupin, earning just 16%, and Sun Pharma earning only 15% on its investments. So let me just go through all these 6 ratios again. The highest ROE of the last 5 years on average was of Ajanta Pharma, earning 35% on the shareholders' money. The worst performance was by Sun Pharma, earning just 17%. The recent ROE was worst for Lupin, earning just 2% on the shareholders' money, and Natco Pharma performed the best at 29%. Looking at the 5 years growth rate in the RoE, Lupin performed the worst. From where it was 5 years, it has fallen at the rate of 40%. And the best performing was Aurbindo at 13%. Now this degrowth was of course because in the recent year the profit has fallen, so automatically the growth rate would also fall the highest. Looking at the RoCE, Ajanta has done the best at 46%, and Glenmark has done the worst at just earning 17% on the total capital employed into the business on average from the last 5 years. In the recent RoCE, Lupin has again performed the least at earning just 10% on the total capital employed, and the best was Natco Pharma earning 34% on the total capital employed. Now what happens is when 1 year figure or a net profit value of a company is disturbed or falls, or there is a reduction in the net profit, then it automatically affects most of the ratios. So that is what has happened with Lupin, wherein in the recent 12 months its profit has fallen substantially from 2018 value. On return on assets, Ajanta Pharma has done the best, earning 35% on the total assets employed into the business. Glenmark has managed the least in terms of earning returns on its assets at 9.3%. These ratios helps us understand how the company's management has performed in basically translating the capital, the assets into profits. In terms of turning its assets into sales, Ajanta has managed to have the highest turnover of its assets at 1.04 times its assets. The poorest of the lot was Sun Pharma, where the sales were 0.5 times less than its assets that it held. The highest return on invested capital was by Ajanta Pharma at 38%, and Sun Pharma did poor at earning just 15% on its total capital or its invested capital. Next, let us look at the other ratios. In this analysis, what we are going to do is we are going to compare the profit after tax of the last 5 years with how much of that was converted into cash, that is cash from operations, and then we will also compare what was the free cash flow of the last 5 years, and we have to compare this with the cash flow from operations. So there are two steps we need to do. First, we will compare the cash flow from operations with PAT, that is how much of the earnings got translated into cash, and then what was the portion of the free cash flow with the company when compared to what it earned through operations. This comparison is reflected in these two ratios, which is CFO to PAT comparison and then free cash flow to cash flow from operations comparison. These are a 5-year value comparison, so it gives us a very good idea as to how much of the earnings that the company is saying that it has earned, of that how much got converted into cash. It is very important that the company has something to show for its earnings in its bank account or at least in its balance sheet. So the Lupin's profit of the last 5 years was 9,349 CR. So against this earnings, the company has generated a cash of 10,219 CR, which is more than the earnings, and the percentage wise it works out to 9.3% more than the earnings. Other companies, CFO to PAT, in fact Natco Pharma had a negative cash flow from operations to its PAT. I stand corrected, it was not negative, but the cash flow was short by 26.6% of its earnings. That is, the company had shown an earnings of 1500 CR. Against that, only the cash of 1100 came in. So, as investors, what we want to look here is the cash component to be more than the earnings that the company has shown in its P&L account. We at least want it to be either equal or more than the earnings value. So here the cash has fallen short by 26%. As investors, we want to see a value which is positive and more than the earnings. Glenmark Pharma has managed to increase its cash earnings by 13% more than its earnings. Ajanta Pharma, we don't have the values here, so we will not be able to analyze. Sun Pharma has managed to increase its cash earnings by 11%, and Aurobindo was short by 10%. Out of 9,500 CR of profit, only 8,500 has come in as cash. The balance is not reflected in the earnings. Similarly, for the free cash flow, we don't want the free cash flow to be more than or falling more than 50% of whatever it has earned through operations. Let me just repeat that. We don't want the free cash flow to be less than 50% or fall more than 50% of its cash flow from operations. So here we see that the free cash flow has fallen at a rate of just 7% from its cash that it earned in operations. That is 10,219 was the cash the company earned in last 5 years. Out of that, it still has 9,495 CR as free cash flow. That is, it just spent 7% more out of this cash from operations. So we don't want to see a very high negative value of above 50%. Natco Pharma's free cash flow has fallen by 92%. So the company had earned a cash of 1158 and the free cash flow lying with the company is just 88 CR. That is 92% of it has been spent out in investment activities. Let us look at the Glenmark. Glenmark 2 is similar like Natco, where the free cash flow has fallen by 89% of the cash flow from operations. So out of the cash flow of 3,900, just 430 is left with the company as free cash flow for distribution, as dividend, or for acquisition. We want a good percentage. We don't want to see such a high fall in the free cash flow. Now, the reason why these companies have a low free cash flow could also be due to heavy investments in R&D and so on. So the company may be investing in fixed assets or buying of buildings, plants, and so on. So here it could be positive, it could be negative, depending on how the company has utilized its cash in the investment activity. Sun Pharma's free cash flow is 44%. So this is good sign. So basically, out of 27,250 CR, it still has a cash of 15,236 CR, which is a good sign. That is, just a 44% was invested in the investment activity of the business. Finally, Aurobindo cash was 65% used up in the investment activity out of the operations. So in terms of CFO to PAT of 5 years, we see that the best cash flow conversion was done by Glenmark Pharma, where it managed to get 13% more cash than its earnings. Whereas the worst performing in terms of cash, Natco Pharma, was short by 26% from its earnings. In terms of free cash flow to cash flow from operations comparison of the last 5 years, Natco Pharma has done the worst by just having approximately 8% left out of its cash from operations. That is, free cash flow was just 88 CR out of the cash that the company earned of 1158. Not only that, even in terms of CFO to PAT, it was not up to the mark by falling short of 26%. So in terms of both CFO to PAT and FCF to CFO, it has not done well. Looking at the free cash flow for the best company is of Lupin, where it has just managed to spend out of 10,219 CR, it still had 9,495 CR left as free cash. That is, it spent just 7.09% on its investment activities. This is not necessarily good or bad as such, but we want that the free cash flow should be at least 50% of the cash flow from operations. Moving on to the next ratios, let us look at these 7 ratios together. In these ratios, what we are going to do is, first of all, we are going to compare the current year's PAT with the average PAT of 5 years, and we will try to understand whether the latest year's profit is above the average profit or below the average profit. After doing that, we will compare how the profit has grown or how the profit has fallen down from its previous year's net profit, whether there is a growth or whether there is a fall in profit. And finally, we will compare how much of the last year's profit that the company showed was converted to cash by comparing the cash with the profit after tax. So let us begin with the first Lupin. We'll compare how this year's profit after tax has compared with the average. So we see that this year's profit has fallen 62% below its average. That is, on average, from last 5 years, company was earning 1,870 CR, whereas the latest 12 months profit after tax value is 700 CR. That is a fall of 62% from its average, which is not a good sign. We always want to see above average value, anything above plus 1%. Natco Pharma has managed to gain 104% more than its average. On average, it was 316, and latest year's profit was 644 CR, that is 104%. Similarly, Glenmark managed to earn above its average by 16%. Ajanta Pharma just managed, in fact, it just fell slightly below its average by 0.46%. Sun Pharma's profit fell by 22% below its average. Out of 4880 earned on average in the last 5 years, the profit of the latest year was just 3774, that is a fall of 22%. Whereas Aurbindo managed to gain by 27% above its average profit. Next, let us look at the growth in profit from the previous year, that is the recent profit compared with the previous year's profit. What was the growth in that? Lupin had a growth rate of 148%, although if you look at it, the profit after tax of the 12 month was 700, and previous year it was 282 CR, that is in 2018. In fact, we don't have the 2019 value here. Okay, so this is correct. It has gained by 148%. In the 2018, the total profit was 282 CR, whereas in 2019 the profit has increased to 700 CR. That is a 148% jump in its profit from the previous year. Natco Pharma's profit has declined by 6.4% from its previous year's profit, and Ajanta Pharma has fallen by 17% from its previous year, whereas Sun Pharma has gained 31% from its previous year's profit. This is the second comparison. Now finally we'll understand what was the profit that the company showed and how much of that got converted into cash. Aurobindo's profit from the previous year fell at the rate of 0.17%. In terms of how much of the profit was converted to cash in the last year, Lupin managed to convert 521% above its earnings. Its earnings were 282 CR and it managed to convert cash of 1751 CR. So from 282 of earnings, it converted 1751 in terms of cash. So that was 521% more than the profit after tax. This is a good value. We want to see more cash in terms of earnings. Natco Pharma was again short in the single year also by 32%. It showed a cash and earnings of 688 CR, whereas the cash coming in is just 464 CR. So we would want to see a positive growth rate just like in 5 years. Glenmark managed a cash of 104 CR more than the earnings. Ajanta Pharma fell short by 39%. Sun Pharma had excess cash coming in by 35%, and Aurbindo Pharma was short by 19%. So out of the profit of 2,435, it received a cash of 1955. Here what we want to see here is that the cash component is more than the earnings. Most good companies would have a cash figure equivalent to or equal to the profit after tax. The highest profit earned above the average was by Natco, and Lupin's last year's profit fell by 62% below the average of the last 5 years. In terms of profit after tax, that is a year-on-year growth rate in profit, Lupin had the highest growth rate of 148%, and Ajanta Pharma had profit which declined by 17% year on year. In terms of cash generation, how much of the profit was transferred or converted into cash, Lupin managed to convert the maximum of its profit into cash, whereas Ajanta Pharma fell short by 39%. Next, let us check at the quarterly results YOY, that is March quarter to March 18 to March 19 quarter, and then even we'll look at the quarter on quarter, that is from December quarter to March quarter, sales and profit growth rate. So what we have done at the previous analysis was, first we analyzed the 5 years cash flow and the profit growth rates. Then we looked at the annual growth rate in profit as well as how much cash was transferred or converted from earnings. And now we are looking at a very short-term picture of a quarterly analysis, what is happening in the 3 months period in the companies. So this completes the entire picture of the analysis from long-term view to the very short-term view. Lupin's quarterly sales growth, that is year on year, from March 2018 to March 2019 quarter, had a growth rate of 9.23%. Natco had a fall in its sales. There was a degrowth in sales, or the sales fell by 40% from March quarter of the previous year. Aurbindo had a high growth rate in its sales of 30% from its previous quarter. Looking at the quarter on quarter, that is December to March quarter, there was a slight degrowth in sales, or the sales fell by 2.19% for Lupin. Natco Pharma's sales dropped by 18%. Most of the company's sales were growing at a very marginal rate, except Ajanta Pharma, which managed to gain 6.19%, although year on year it had a fall in its sales by 2.86%. Let us look at the profit growth rate, again YOY first and then quarter on quarter. Lupin's profit for both March to March as well as December to March were negative. The profits fell by 46% from 1 year ago period, and from previous quarter it fell by 290%. So there was a drastic fall in profits. Natco Pharma's profit also fell by 59% YOY and 24% QOQ. Sun Pharma also had a negative quarter on quarter as well as YOY degrowth or decline in profits. When we look at the YOY sales growth, the highest sales growth was in Aurbindo and maximum fall in sales was of Natco Pharma at 40%. Short term Q over Q, Natco Pharma again had the maximum sales drop of 18%, and Ajanta Pharma had a growth of 6.19%. Quarter on quarter profit growth rate, that is YOY, maximum profit growth was in Aurbindo, and in quarter on quarter Glenmark performed the best at 38%. Natco Pharma's profit fell the most YOY at 59%, and quarter on quarter Lupin's profit fell by 290%. So these ratios help us understand the very short term picture of what is happening in the company. Next we'll look at the net worth of the company, or how big the company is. This is not the market capitalization, this is the actual value of the company after it clears off all its liabilities by selling all its assets, and then what remains is its net worth. And then we will compare what is the contingent liability of the company and compare that with the net worth. Contingent liability are those liabilities which may or may not arise in the future, and these liabilities are not accounted for in the financial statements. That is, these liabilities are not shown in the balance sheet or profit and loss account. So we have to make sure that contingent liability does not exceed 20% of the net worth. And as we can see, none of the companies' contingent liability exceeded 20% of the net worth, except for Sun Pharma, which neared around 17%. As for the net worth, the largest company or the biggest company in terms of value is Sun Pharma at 41,000 CR, followed by Lupin and Aurbindo at 13,000 each. Next, let us check the debt to equity ratio and what is the coverage the company has on its interest cost. And then we'll also compare the debt with the profits of the company. These three ratios we'll cover at one go. This debt to equity ratio signifies what was the borrowings that the company did against what the shareholders had invested in the company. So this allows us to understand which component of the capital is more, and if the borrowing is more than the shareholders' funds, then the company will have to pay more interest cost on those borrowings, which will in turn reduce the profits that the shareholder would get. Now we don't want the debt to equity ratio to be more than 1 times. Debt to equity ratio varies with industries, but generally we should look for debt to equity ratio of less than 1 times. Meaning debt and equity, if it's similar, then the ratio becomes 1. Lupin's debt is 0.6 times of its equity, meaning debt is less than the equity. Most of the company's debt in this sector is almost half of its equity, which is a good sign. Glenmark's debt is the highest in the group companies, followed by Lupin, and the lowest debt is of Ajanta Pharma. Now, whatever the debt is or the borrowings the company has done, on that it will have to pay the interest. The interest coverage ratio here measures how much of this year's profit, using this year's profit, can we pay off the future interest payments. Or, in other words, we understand what or for how many more years can this year's profit cover the interest payments of the future years. Lupin's profit can cover 7 years of the future interest payments using this year's net profit. Natco Pharma, since it had a very low debt to equity ratio, can cover 43 years of its interest cost using this year's profit. This ratio helps us understand how well the company is managing its interest cost. Finally, let us look at debt to profit, that is, of the profit earned this year, how much was the debt against that. Lupin had a debt of 32 times more than its profit. So as the profit increases, the debt to profit component decreases. And if the profit decreases, then the debt to profit component increases. So because Lupin had less profit in the latest year, many of these ratios are based on the latest year's data. So these points reflects not only the long-term picture but even the current or the latest year's values or net profit. So the debt has ballooned to 32 times of the profit. So this ratio in turn just makes us understand that the company will have to earn 32 years. If it earns the profit what it is earned in the latest year, then only will it be able to cover its borrowings. It will be able to pay off its borrowings in 32 years with this kind of profit. So here we want a value which is as low as possible. Natco Pharma doesn't have much debt or borrowings. Therefore, with this year's profit, in fact, this year's profit is more than the debt or the borrowings that the company has done. Glenmark's borrowings are 4.8 times more than this year's profit. This is not a very high figure. Within next 4.5 years, if it wants, it can clear off its entire borrowing with the profits that it is earning. Ajanta too has marginal or very minimal of debt against the profit. Sun Pharma is very similar to Glenmark, where its borrowings are 4.5 times higher than its profit. This year's profit, that is. And Aurobindo's debt to profit is 2.79 times. That is, our borrowings are 2.79 times higher than this year's profit. So in terms of debt to equity, Ajanta Pharma has done the best of keeping its debt as low as possible, and Glenmark had the highest debt compared to its equity at 0.69. Even though this is less than 1, in the peer group company it has the highest debt to equity. In terms of interest coverage also, Glenmark's coverage is just 4.39 years when compared to other companies which have much higher coverages. Because of higher debt, the coverage correspondingly falls. Ajanta Pharma's debt is minimal, therefore coverage is the highest. In terms of debt to profit also, Ajanta has done the best of having a debt of just 0.07 times its profit of the latest year. Many of these ratios you'll need to read online, understand them, or listen to this video again. I may be a little fast in the way I'm talking, but because I know these things and I've gone through them hundreds of times. I can relate to them by just looking at the numbers. I get a picture out of these numbers. Lupin's debt was 32 times higher than its profit. The profit has fallen quite a bit, so it has performed the poorest. Next, we'll look at the change in promoter holding from 3 years back and what is the current promoter holding and if there is any pledge on the promoter's shareholding. These three ratios we'll look at one go. Most of these companies' promoter holding hasn't changed much. In fact, Natco Pharma's promoter holding has increased by 0.29%. But it is hardly anything. So what we'll do is we'll not give it a score here. Let us look at Lupin. Promoter holding currently is at 46%. Most of these companies are above 45%. And the highest is Ajanta Pharma having 70% of the promoter's shareholding. Lupin hasn't pledged any shares, neither has Natco and Glenmark. Ajanta Pharma's promoters have pledged 15%. Up till 20% is okay. Anything about 20% kind of raises red flag and we should be careful that the pledge doesn't increase. Here too, this is not a problem because the promoter holding itself is very high and 70% of the 70% that the promoter holds, only 15% is pledged. So even if everything is sold off, the promoter holding share will still not go below 50%. Sun Pharma's promoter have pledged 10% and Aurobindo's is marginal at 3.49%. Again, the promoter holding of Ajanta Pharma is maximum at 70%, whereas Glenmark Pharma's promoters hold only 46% in the company, which is the lowest in the peer group. As for the pledge, all the three companies, Lupin, Natco and Glenmark, have not pledged any of their shares. Highest pledge is of Ajanta Pharma at 15%. Next, we'll look at the debtors to sales percentage and then we'll also look at the debtor days and how much were the debtor days 3 years ago. These three ratios again we'll look at together. The debtors to sales percentage signifies what portion of the sales of this year, of the current year, and how much were the accounts receivables or how much of that sales were pending to be collected. This value we'll get it from the balance sheet in the accounts receivable portion. This percentage basically helps us understand whether the debtors have exceeded a percentage of sales and by what percentage. So here we don't want the debtors to exceed 30% of this year's sales, meaning not more than 30% of this year's sales should be pending for collection. Lupin's debtors were 30% of the sales of this year, meaning if the company has done a sales of 100, then 30 are still pending to be collected at the end of this year, that is 2019, which is at the borderline of our benchmark. Most of these other companies are also around less than 30%. Sun Pharma is also near 30%. The best is Aurobindo, which has managed to keep its debtors at 17.45%. Let us look at the debtor days. These are the days within which the company collects payments from its customers. We don't want the credit period given to the customers to exceed 90 days. We want the collection by the company to be done in less than 90 days. Anything above that is a kind of a red flag because a very high credit days means higher chances of bad debts or customers not paying back to the company. Lupin is taking 120 days, which is the highest in the peer group companies, to collect payment from its customers. Not only that, but the when compared to last year's sales, 30% of that was still pending to be collected. Natco Pharma is also gone above 100 days, as well as Sun Pharma above 100 days. Most of the companies have managed to keep it below 90 days. Let us look at 3 years back where these companies were. 3 years back, the company was collecting its payment from the customers within 76 days, whereas currently that has increased to 120. So this is not a good sign. What we want to look at is the debtor days falling, that is the collection days, the period within which the company is collecting payment from its customers, reducing as years go by and not increase. When the company starts collecting payments faster, that shows that the company is efficient in collecting payment, and it wouldn't need a lot of money for its working capital needs, and it can redeploy that money which it collects faster into its business to expand the sales growth. Natco Pharma's 3 years back also it was 85 and has increased to 107. Glenmark has reduced from 140 days to 94 days. This is a good sign for Glenmark Pharma, which has started collecting at a faster rate from its customers. Ajanta Pharma's collection days has gone up from 64 to 84 days. Similar is the case for Sun Pharma, which has its collection days gone up from 68 to 108. We don't want to see these kind of values above 90 days. Aurobindo has done well to reduce it from 107 to 68. Now it is the best as of today in terms of collection from the customers. So in terms of debtors or customers still pending to be collected, Lupin had the highest number of debtors from whom it had to collect payment against this year's sales. Where not only that, but the amount of days it is giving to its customers to pay to the company for the credit sales is 120 days. So in terms of both the collection to be done and the collection days is the highest for Lupin, whereas Aurobindo has done the best of keeping the total customers which are on credit at the lowest level and also collecting from them at the fastest pace. So this is what investors should look at. Not only should the debtors be less or the accounts receivable or the amount to be paid by the customers to be at the lowest level, but the collection period or how fast it collects from the customers should be the highest or fastest. Let us look at the inventory turnover and where the inventory was 3 years back. These two ratios will cover at one go. This ratio, inventory turnover, measures the sales multiple or how many times was sales more than the inventory holding. So the sales were 4.3 times higher than the inventory of the latest year. Here we want a value as high as possible that shows that the inventory has been turned over at a very high rate. Most of these companies have managed to around 4-5%. Ajanta managed to increase its inventory into sales 7 times more. Let us look at the inventory turnover 3 years back. So what here we want to look at is a higher turnover from where it was 3 years back. Most of this company, Natco, has managed to increase its current inventory from 3 years back. Glenmark has managed to be very near to its where it was 3 years back. Ajanta Pharma has fallen from 9 times its inventory turnover to 7 times. Most of the company have managed to keep the inventory and the sales ratio at the same levels. Let us move on to the 5 years operating profit margin percentage. That is, what was the operating profit margin that the company has been earning on average since last 5 years. And then we'll look at the latest NPM margin of the companies, and then we'll compare it with the previous net profit margin that the company had earned. These three ratios we'll look at together. This is the top line. The operating profit margin is known also as the top line. It earned 25% on its sales after deducting the operating expenses. Natco earned 33%. Most of these companies OPM has been about 20% except Glenmark, which was very near to 19.32%. Net profit margin is the final margin after deducting all the expenses. Here too we want the value to be above 10% and the OPM margin should be above 15%. Lupin's net profit margin for the latest year was just 1.59%, which is due to some asset write-off or some similar thing which was a one-off write-off, and because of which the profit had fallen substantially from a year ago period. So in the latest year, that is 2018, this value is of 2018 where it managed to earn just 1.59%. Whereas in the previous year, it had earned a 14% NPM. Natco Pharma had earned 31% net profit margin in the latest year, and in the previous year the profit margin was 24%. Ajanta Pharma has also managed a double digit about 20% net profit margin for both the years. For the 5 years average OPM, Natco Pharma had earned the maximum at 33%. Even the latest year's net profit margin was the highest at 31%. Whereas Glenmark did poorly at 19% on the 5 years OPM in the group company, and Lupin's current net profit margin was the lowest at 1.59%. In terms of the previous year to that, the NPM of Glenmark was the lowest at 12%, and Ajanta managed the highest NPM of 2017 at 25.56%. Let us look at the last three ratios at one go, and we'll finish our analysis here. The current ratio, quick ratio, and the dividend yield. Current ratio is and gives us an understanding of where the company is in terms of liquidity position. That is the company competent enough to pay off all its current liability or those liabilities which will be arising in 1 year by selling the assets or current assets which it can dispose of within 1 year. So we want the current asset to current liability to be more than 1 times. That is, the current assets should be easily able to cover all the current liabilities, and still we should be having some current assets holding with us. So the higher the number, the better it is. The lowest number is of Glenmark, where it had 1.67 times its current assets, and although it can easily cover its current liabilities, in the peer group it had the lowest asset liability ratio other than Aurbindo at 1.28 times. The maximum current liability coverage, current ratio coverage was of Ajanta at 3.31 times. That is, it had 3 times more assets than its current liabilities. In terms of quick ratio, this ratio includes only those assets which can be quickly sold and converted to cash, and then using that to pay off the current liabilities. Quick ratio helps us understand the fastest way that a company can sell off its assets and pay off its liabilities. So in terms of quick ratio, Natco Pharma had the highest assets or quick assets to pay off all its liabilities. Aurobindo quick assets were not enough to pay its current liabilities. Let us look at the dividend yield. Dividend yield measures what was the dividend paid by the company on the latest price available with us. The higher the value, the better it is, but that is just an additional bonus point for the shareholders other than the growth in the price of the shares. So in terms of liquidity position, Natco Pharma was having the best liquidity position to clear off its current liabilities, whereas Aurobindo had the least liquidity position, and in case if the company had to clear off its quick liability or liability quickly, then it wouldn't even be able to manage that because its quick ratio has fallen below 1 times. In terms of dividend yield, Natco Pharma has paid the highest dividend in the group companies, and Ajanta Pharma has not paid any dividend. So this completes the analysis of Aurobindo Pharma, Sun Pharma, Ajanta Pharma, Glenmark, Natco and Lupin. And I have collated a table of score that the companies have got. The highest score or very nearby, Natco 158, Aurobindo 157 and Ajanta Pharma 156. All these companies have come very close by to each other. Glenmark stands at 126 points. Finally, Sun Pharma at 82 points and Lupin at 76. Most of these companies are in a good category of medicines and pharmaceuticals, and all of these companies are doing well. But as investors, we need to buy these companies at a very reasonable valuations by looking at the price earning or price cash or price book or price to sales and so on, and then come to a conclusion where we can buy the shares of these companies. So in case of Natco Pharma, which has got the highest score, it has fallen 37% from its 52 weeks high. Valuation wise also, it is quite reasonable at 15 times and 14 times its price earnings. In terms of price cash also, it is available at just 20 times. But price to free cash flow is very high at 169 times. Book value is 2.78, which is quite high. We want it to be below 2.5 times at least. Price to sales also, it is very poor at 4.62. That is, price was 4.6 times higher than the sales. So here we want to buy a good company, which Natco Pharma is as per the score, but at a reasonable valuation. So investors can look at charts or graphs and see what price is justified to enter into the companies. Second is, we should look at the valuation of the company, not only in terms of the price but the value or the basic price that the company can generate for us. After that, when we start buying the company or start buying the company's shares, we should not buy at one go. We should break up the purchase that we do into multiple parts. So for example, if you want to buy 1 lakh in Natco Pharma, we can divide it into 10 parts of 10,000 each and buy as the price declines by 1%, 2%, or whatever is our targeted percentage drop. For me, I follow RSI in chart or relative strength index on the chart by looking at the weekly charts and buying only when the RSI falls below 30 line. And then I wait out. I buy gradually, and I wait out that period where once I'm done accumulating, you have to wait patiently, hold on to it for a year's time till the market cycle turns and the price moves up. There is a very difficult time that one has to complete within the time that one has to wait patiently takes a toll, and investors need to have lots of patience to hold on to the stocks and not sell, not panic due to fall in price. If the company fundamentals are good, one should hold on for long term, at least 1 year, 2 years, where one can expect 50%, 100% return or even more. Thank you for watching the video.